I want to talk about how reverse stock splits help manage stock price levels. How reverse stock splits help manage stock price level. First of all, we need to understand precisely what reverse stock splits is all about. So, number one, what is a reverse stock split? A reverse stock split consolidates the number of outstanding shares into fewer shares, increasing the stock's price per share without changing the company's overall market capitalization. For example, in let's say a 1-for-5 reverse split, 5 existing shares are combined into one, and the stock price multiplies by 5. Let's take, for instance, you have a stock selling for maybe $10. You understand? And you split that particular stocks into, if you split it into 5, that's a normal stock split. That will give you, each stock having a price of $2 per share. You split a single stock of $10 per share into 5. That will give you what? That will give you, $2 per share for the 5 individual stocks. That's the normal stock split. In the case of reverse stock split, you have 5 stocks of $2 each, consolidated or combined into a single stock of $10 each. That is what is called reverse stock split. 5 stocks of $2 each combined into a single stock of $10 each, of $10. That's what is called reverse stock split. So in that case, it is in a ratio of 1-for-5, 1-for-5 split. That's 5 existing shares, being combined into one. So it reduces the number of shares outstanding. And when there's a reduction in the number of shares outstanding, the earning per share will increase. It will certainly increase. Number 2 is common reasons for reverse stock splits. Common reasons for reverse stock split. We have regulatory compliance. Regulatory compliance. Companies often use reverse stock splits to avoid delisting from the exchange. From exchanges like the New York Stock Exchange, or the NASDAQ, which have minimum price requirements of example $1 per share. That is the minimum price requirement. The price should not go below $1 per share. In a case where the stock price goes below $1 per share, then there will be a reverse stock split to increase the price of the individual shares. We probably have a market perception. So in this case, a higher share price, can improve investor perception, as low price stocks are sometimes viewed as risky or unstable. So you want to have a better perception. Then a stock carrying a higher price per share is viewed as being stable. Well, it may or may not be, but that is the general perception. Then institutional investments. So many institutional investors avoid such, stock prices below a certain threshold. So a reverse split can attract these investors by boosting the stock price. Usually, all these investors at the institutional level, they usually go for bigger cap, stocks, higher price stocks. So anything below a particular threshold may not attract their investments. So you want to attract them, you need to carry out a reverse stock split to bring up the share price and attract institutional investors. There's merger or acquisition goals. Merger or acquisition goals. So companies may execute a reverse stock split to make their shares more attractive for mergers, acquisition, or partnership. Companies who are targeting, merger or acquisition, could adopt this particular strategy to make their stock price to go up so as to attract uh, merger partners or make themselves suitable for acquisition. Number three, how it affects stock price level. How does reverse stock splits affect stock price levels? So in this case, there's that increase in share price. It brings about increase in share price. And so the immediate effect of reverse stock split, is an increase in the per share price, which help meet, exchange requirements or psychological threshold for investors. It's merely psychology. People feel, a higher stock price connotes a better performing, company. It may not be the case, but that is the usual perception. There's also liquidity and volatility. Liquidity and volatility. While the share price increases, the reduced number of shares can decrease trading liquidity, potentially increasing price volatility. That's another effect we must take into consideration. Number four is psychological impact on investors. Psychological impact on investors. So in this case, you have a kind of mixed perceptions. There's the positive as well as the negative perception. So let's talk about the positive perception this time around. So in the area of the positive perception, some investors view reverse split as a sign of proactive management addressing issues like low stock prices. Then we consider negative perception. In this case, others may perceive it as a signal of financial trouble, particularly if the company struggles to improve fundamental, post splits. That is, if after they've done a reverse stock split, the company is still not doing very well, it shows that there's a problem actually. Please like this video and subscribe to this channel if you've not done that. Number five, long-term implications. Long-term implications. Not, it is not a fix for fundamentals. In other words, it doesn't really fix fundamental problems that may be bothering the company. So a reverse stock split doesn't improve the company's underlying financials, health, or profitability. It doesn't. It doesn't make a company more profitable, and it doesn't in any way, improve the company's, fundamentals. So without, strong fundamentals, the stock price may decline again. Usually because fundamentals equally, fundamentals essentially, is what controls stock price. So in a case where the fundamentals declines or is on a decline, even if you carry out a reverse stock split, it will not reverse the company's financials. Then you have potentials for recovery. Potential for recovery. If this reverse split is part of a broader turnaround strategy, it can be it can be a step towards stabilizing the company and regaining investor confidence. It might help to regain investor confidence, all things being equal, if the company embarks on a recovery trajectory. Number six is key consideration for investors. Key consideration for investors. You have research and reason. You research the reason. Research the reason. So understand why the company is implementing the reverse splits, and assess its financial health and growth prospect. Don't just be carried away by the fact that the company is implementing a reverse split. Ask yourself, why are they doing it? All right, and then take time to critically assess the company's financial health. So you also monitor market reaction. Monitor market reaction. Watch how the market reacts to the reverse splits, to the announcement, and then you equally monitor the post-split, trading pattern of the stock. And then lastly, avoid assumptions. Avoid assumptions. A higher stock price post-split doesn't necessarily mean the company's value or prospect has improved. No, it doesn't mean that the company has a better prospect. Everything is based solidly on the company's financial performance and nothing else. So reverse stock splits, are primarily a tool for managing, stock price level and investors' perception, but their effectiveness depends on the company's broader strategy and, more importantly, on its overall financial performance.